Hello, Garrick Wordmuller here. I have a little presentation for you guys to kind of explain what the heck is going on in mortgage world right now, and real estate and inflation world and all that good stuff, with something I like to call rates, real estate, and recession. Let me go ahead and share my screen here, and we will get going. All right. So real estate rates, real estate, and recession. What is going on? So what we're going to talk about here is the 2022 mortgage rate dynamics, including inflation, which is the huge buzzword right now, as well as Fed hikes and balance sheet runoff, and then talking about are we headed to a recession right now? So let's look at history, and if we see a pattern, Mark Twain once said, "History doesn't repeat itself, but it does tend to rhyme." Excuse me. Back in the 70s, we had Burns and Volcker. And we saw inflation go crazy, right? We saw inflation go from 7% to 14%. And mortgage rates at that time actually went from 12 to 18%. And the federal funds rate went from 11% to 20%. And then, as a response to raising rates, we did see inflation go down from 14% to 5%. And we saw mortgage rates go from 18 back down to 12%. Moving on to Alan Greenspan in the 2000s, we saw inflation go from 1.75% to 3.5%. Mortgage rates went from 7% to 8.5%. The federal funds then raised rates from 4.75 to 6.5%. And the inflation response was it went down from 3.5% to 1%. And then mortgage rates actually went down from 8.5 to 5.5%. So another significant drop. Now we're looking at Jerome Powell, and we've seen inflation go from 1.5% to 8.5%. We've seen mortgage rates jump just this year from 2.5% to 5%. And we're going to see it's a prediction here that the federal funds rate is going to go from 0% to 3% in 2022. Inflation response, we should see a drop in inflation. That's the objective here, right? And then we should see a decline in mortgage rates as inflation declines as well. Now let's take a look at hikes when the feds do hike rates and the impact on mortgage rates on the runoff. So we see here in 2016, we had a federal fund rate hike, and we saw mortgage rates come down. Again, in 2017, we see, every time we had a rate hike, mortgage rates went down a little. It wasn't around here, October 2017 through April of 2018. All of 2018, we had some pretty high interest rates. So you can see here they did hike rates, and mortgage rates just went up due to runoff increases. But here they hiked the rates, and we see it finally takes hold. And we saw rates in 2019, like end of 2018, beginning of 2019, really, we saw mortgage rates really start coming down. And then, we saw all of 2019, we saw rates going down, basically. Now let's look at the inversions to the yield curve and recessions. Now, when we have an inverted yield curve, what that means is the 10-year treasury is yielding a lower rate than the 2-year, which is very abnormal. If you invest your money in something for 10 years, right, you're going to think you have a bigger return than if you invest your money in something for 2 years. You should have a better return for a longer period of holding. Just recently, we see, though, in April here, just now, we're seeing that the 2-year is yielding, and that has a lot of people speculating that a recession is in the wings, and we tend to agree. Okay, so here's another look at inversions leading to recessions. We have the 10-year minus the 2-year treasury here since 1970. And so you can see when the 10-year goes below and it's an inverted yield curve, we have a recession. We have a recession. We have a recession. Even here, this is the 2007. We had that big recession, 2008-9. We had a little recession at the beginning of 2020. Just then the pandemic hit and everything kind of changed. So, but you can see we are right on course with this logic. All right, let's look at unemployment and recession. So as soon as we see unemployment going up, it typically means we're headed into a recession. So here you can see back from the 50s, even whenever there's an employment rate going up, we're in a recession. Employment goes up, we're in a recession. Again, here numbers are skewed due to the pandemic, but we did have a small recession, and then obviously, unemployment shot way up again due to the pandemic. So then looking at mortgage rates and recessions, you can see here every time we've been in a recession, we've seen rates go down 3.75 to 2.75 more recently, from 6 to 4.875 in 2008, 7.375 to 6.75. And you can see the trend. Typically, when we're in a recession, mortgage rates will go down. Now, housing, let's look at housing. Housing does tend to actually stay strong through recessions. And so we can see since the 60s, housing has remained pretty stable. Here we see a big decline, but this was the 2008 recession. That was basically caused by the mortgage market, right? And this was a lot of people that shouldn't have been buying homes were buying homes and multiple homes. And so we know what happened there. But typically speaking, housing does stay strong through a recession. Okay, and then we also have record low inventory. So we can see at the peak of the housing market in 2007, there was 3.7 million homes. Here, there's only 870,000 homes as far as inventory is concerned. And if you couple that with the fact we have 14 million more households and 3 million fewer homes, we do see that housing is very likely going to remain strong just for inventory purposes alone. So those are kind of the predictions we see as far as rates, recession, and real estate, or rates, real estate, and recession. I hope you enjoyed this. So there you have it. That's what we're predicting as far as rates, real estate, and recession. I hope you enjoyed this presentation. If you do have any questions, you can reach out to me. Here's my website. Please do like and subscribe. And remember that I'm always here to help you out for some good, honest advice. Independent mortgage brokers that work for the people.
Yeah, Fresh Home Loan Inc. You want mortgage rates without breaking your bank? Well, I got what you need. I'll keep it 100. The very best lender. We sell money, yeah. There's really no equal. Independent mortgage brokers that work for the people. I know that the pandemic's brought many problems. What we offer is better rates.